All right, we are going to go ahead and get started. Today is Monday, March 29th. Recording is on. Uh, Today marks the beginning of the third part of the class. We're going to start building a valuation model, an enterprise DCF. You're going to be doing that for the next 2 weeks with me. So in terms of assignments, basically what's going to be very important is right now you need to go grab a file, share my screen, on Elms. It is under Files. It's in a folder called WMT for Walmart. It's a file called Valuation Model WMT Start.xlsx. Right? You will need that file. So this class and the next few, we're going to start with that Excel model. I'm not starting completely from scratch, but we're going to build a valuation model for Walmart and then have that valuation done by next week. So your next homework assignment, which is due Wednesday, is basically to replicate everything we do with that Excel model, because you're going to be building it yourself, following along with me, and then you're going to submit that file that matches exactly what we do in class today. That is your homework that is due Wednesday. On Wednesday, we will pick up from that point and continue working with that file to create more of the valuation model, which you will then submit on Monday, 1 week from today, as your next homework assignment. So the next two homework assignments are pretty much you building the valuation model. And so again, you need to get that file, and I'll give you a minute or so to get it before we get started. While we do, a couple of other things. The midterm solution, I just posted here. It's in the file section. So if you wanted to see the mathematical solution to your midterm, there it is. And then the other thing I wanted to mention is we have started the second half of the Bloomberg Trading Challenge. And just to make sure everybody understands what that means. So if you go to idea or T message, then what's going to happen is your first half portfolios are still there. They just don't count anymore in terms of the grades. So what your team captain needs to do is select from the drop down basically a second half, so section 1 or sec 2H portfolio. That's the second half, 443 spring 2021 2H. Okay. So I'm going to be lenient because technically one of the teams would be disqualified for not following the directions. But since they might have been a little ambiguous, I'm being really clear now. This final team has to start trading. Okay, there's only 5 teams that are currently trading this semester, and the deadline to get out of cash was this past Friday. So I'll give you 2 more days to Wednesday's class. But if that team doesn't start trading, you're going to be disqualified. You're going to get a 0 for the second half of the semester. So there should be no excuses. This is how you get to it. Okay? So if there's any ambiguity, now's a good time to ask. No more leniency. Okay? The other teams seem to be following the instructions. Had to have less than $300,000 worth of cash, minimum 10 trades, second half of the semester. 3 teams have already met that threshold. The other teams have several weeks to make the rest of the trades. Okay? Same rules as the first half. All right, that's where we stand as of today. Okay, so let's start talking about building a valuation model for Walmart. So we're going to do this in Excel with that Excel file that I posted. As I said, in just a minute you're going to be following along with doing what I do. So let me go ahead and open up and share that file. Okay, so again, this is the file that's in the files section under a folder called WMT. We're all going to be starting with this file, Valuation Model, WMT Start, and in just a minute we're going to build the first step of the valuation. But while we're getting that file ready and open to get to this point, I just want to give you a walkthrough of what I've already created for you. So what this file will represent is the beginning of a reusable valuation model tied to Bloomberg. It will take us 2 weeks to do the valuation of Walmart. It will take us 10 minutes to do the second company. So what we're building is a model that will eventually be tied to the Bloomberg service, and essentially it will be reusable, and we'll be using it heavily the rest of the semester. But rather than just giving you the model, I have found over the years that if I just gave it to you, you have no idea, it just becomes a black box why everything works. So I think it's more efficient if you actually build it yourself and start to understand how the linkages actually work. So let me tell you what's basically here. So the model works in a series of tabs in Excel that kind of work from left to right. First tab here is called Model Data. And what this represents is 6 years, arbitrarily, of data from Bloomberg, income statement, balance sheet, cash flow. Basically, it's FA custom. And what I found is that over the years, Bloomberg actually doesn't have standardized income statements and balance sheets, which is surprising because they say they do. But even they admit, if you ask them, that there's like 5 different versions of their standardized statement that kind of vary by industry. And even then, there's exceptions all over the place. So basically, to use a reusable model, we needed standardized statements. So since Bloomberg doesn't really have completely standardized statements, we've created our own. And so that's the point of this tab. This tab just assembles all the raw materials to create the standardized statements. The standardized statements are over here in a tab called Income and Balance Sheet. So essentially what these two tabs do is these are historical, 6 years of historical income statements and 6 years of historical balance sheets. Now the important tab in this model is called the Ratios tab, one over here. And this follows the process that we're going to use for valuation. Because when we forecast, the best practice is that you don't forecast revenue, you forecast revenue growth rate. You don't forecast an EBITDA, you forecast an EBITDA margin. So what we're going to do is when we build the forecast, it will find that we forecast ratios rather than forecasting dollars, and the ratios get us the dollars. It's just a better way of forecasting a company. So in order to help us do that, this screen will have both historical ratios, income statement and balance sheet, which are created from those historical income statement and balance sheet statements that are standardized. And then we will create ratios to forecast them, which we're starting here in just a minute, and that will create forecasted income statements and balance sheets. Now the other thing the model does is over here is there's a tab called TFI, which you just on the midterm kind of rearrange these to economic format. Well, it helped you out a little bit. And this is a TFI that is mapped correctly to our standardized balance sheet in the model. So I've already reorganized the TFI and got it to balance. Same thing with the income statement. This is the reorganized TII for the income statement based on our standard in the model, which creates the CFI in the model. Okay, so that's all been done for you based on the historical data of the company. And then there's the economic profit. This one's based on beginning of year, and this is the economic profit based on end of year. Again, all mapped to the standardized statements and the standardized reorganized economic statements. And then the final tab in the model is the ROIC tree. So in case you're wondering how the ROIC tree that you've been doing analysis on is built, the model creates it the second you put the data in historically for a company. So that's Walmart's historical ROIC tree through their fiscal 2021 year. Okay? So it's kind of a view of where we're starting with the historical data of Walmart. Questions about that? Hopefully pretty straightforward. All right. So what we're going to do, as I said, is we are going to start creating a forecast valuation of Walmart that will become a reusable model for other companies. And the place where we're going to begin our forecast is in the ratios tab. So now, as I start to edit this model, you need to follow me and do this into your own versions of Excel. Because as I said, you're going to replicate everything I do here for the rest of this class, and then you're going to submit this for your graded homework assignment on Wednesday. So at the end of class, if you have followed everything and done everything we do, you've done Wednesday's homework assignment. If you haven't followed everything that we've done, you have until 10 a.m. Wednesday morning to submit the file. And then this is what we're going to pick up during our next class. Okay. All right. So we're going to start cell H1 over here, and we're going to create a forecast. So I'm just going to put a label across the top to differentiate between the historical and the forecast data. When we build the model, we're going to want to use relative references. So Walmart just completed in January, you can see this over here, based on historical data. This is actual data that goes through January 31st, 2021. Okay? So Walmart is actually in their fiscal year 2022. Okay, because retailers generally do an extra month in their calendar year, go to January because they want to get the whole holiday Christmas season in their revenue. So just most retailers actually don't end their year December 31st, they do it January 31st. So Walmart ended theirs January 31st, 2021. So that is their last reported year. So back over here on ratios, that's why 2021 is an actual. Okay, this is technically 2020, but basically this is their fiscal 21, which is actual. So the first forecast year, current year plus 1, equals for cell H2, G2 plus 1. We want to use relative references. You don't want to hard code numbers. Because we're building a reusable model, if the last reported year changes, so for example, let's say we're not doing a retailer, and the last year was December 31st, 2020, then we'd want the model to auto-calculate the forecast years. Okay? So the other thing that we're doing is there's two places where we're going to make changes to the forecast of the model. And as a best practice, we want to minimize the place where we make changes. So one of the screens which we're going to make changes is here on the ratios. The other screen where we're going to make changes is in this tab called Assumptions. And we're going to build more assumptions as we go on, but the idea is that ratios represent year by year assumptions. We kind of change year by year. These assumptions in this assumption tab are universal that go throughout the whole model. Okay, so assumptions are like one number for everything. Ratios, year by year assumptions that change. Okay, but generally we're going to try and put all of our changes to the model that we make in as little places as possible. And the reason why is because when you build a reusable model, if you scatter your assumptions throughout the model, it's going to cause problems for you because you might forget to change something, just as an example. And at that point, what are you going to do? Trying to figure out where that change was buried in your model could be very frustrating. So one of the things we're going to do is we're going to minimize that happening to us, and we're going to put all the changes in these two tabs. Okay? And then the other thing we're going to do is we don't want to break the model that we are building, because we're going to have a lot of formulas with relative references. And so we're going to know what cells we can change and what cells we cannot change. So I use the color yellow. You can use different color if you want, but the idea is to highlight that this is an input cell that I could change. Okay? So after we build the model, yellow cells I change, non-yellow cells I kind of leave alone because it might actually break my model. Okay? So that's what the yellow cells mean. Those are changeable assumptions. Right now we're going to leave these placeholders in. This is 2021 was the last reported year, which our years are based on. Operating cash 2% of sales and a WACC of 5.3%. All right, so let's come back over here. So first assumption we're going to make is the revenue growth rate. What is the growth of Walmart sales going to be in 2022? As a placeholder, we're going to say for cell H3 equals cell G3, basically equals last year. Okay, so it's going to grow another 6.7%. And then this is a cell that I'm going to make yellow, because that is something that I could change. Okay. Now, just to show you mechanically how this works, we're going to say, okay, assuming that Walmart were to grow at 6.7% in 2022, we're now going to go to the income tab. And again, cell H1, I'm going to label this part of the forecast. I'm going to do a relative year equals previous year plus 1 for 2022. And then for 2022 revenue, we're now going to put in a forecast. So the 2022 revenue equals last year's revenue, G3, times left paren 1 plus the revenue growth rate, which is ratios H3, right paren. Enter. So here's the point, and I'll change the formatting to 1 decimal place, just match everything else. But here's the point. If Walmart were to grow another approximately 6.7%, that would mean revenue would go to 596.71. Okay? So ratios create the forecast. Questions about anything I just did? Hopefully pretty straightforward. Great. So I don't want you to do this, but I'll just give you an example of what we're going to do later. Let's say Walmart's revenue grows at 5% next year. Well, now that's 587,186. So Walmart's revenue grows at 3%. Income 579,925.5. So that's the point. Like, basically, instead of directly forecasting revenue, what we're going to do is we're going to forecast the ratio. The ratio creates the revenue, right? Now, just to all have the same model before we get into the detailed forecast, because we're going to put in a realistic forecast for Walmart relatively quickly. Right now, we're just going to use placeholders. And the placeholder, as we build the model, just so we all have the same numbers, is equal to previous year. We're just going to hold the ratios the same for 2022 as they were in 2021. Okay? So that's the first ratio you need. Second ratio you need is we're going to skip down here and we're going to go straight to EBITDA. Okay, so I'm going to do a little bit of cheating here. And EBITDA in H7 equals last year's EBITDA as a percentage of sales, G7. And that cell is also going to be yellow. Let's make this slightly bigger. It's easier to see. All right, so here's the idea, is that we have to forecast EBITDA as a key driver of our free cash flow. And generally what we would do is to get to EBITDA, we'd also forecast cost of goods sold and SG&A, our operating expenses. But the model doesn't really care about these. What it cares about is the ultimate cash flow. And so for simplicity, we're just going to forecast EBITDA. Now, if this were a real company in the real world and you work for a bank, companies probably do care about their forecast of cost of goods sold and SG&A to get to the EBITDA. Mechanically, you would do that. But for purposes of the model, it's not going to add a lot of value to us to forecast them independently to basically get to EBITDA. So we're going to kind of cheat and go straight to EBITDA as a percentage of revenue for our forecast. Next, depreciation and amortization equals the previous year. And again, that cell is going to be yellow, which then leads to operating income, which we solve for. Operating income equals EBITDA minus the dot. So 4%. Now, since I'm solving for that based on the two numbers above, I'm not making that yellow. It's not a plug. I'm not putting in an assumption. Right? We're actually solving for that number. Okay. Next, we need a realistic tax rate for Walmart, which we'll talk a little bit later about how we get one. But for now, as a placeholder, we're going to leave last year's tax rate, which was 33%. So equals last year's tax rate. And again, yellow. No plat. You can look over and you can see that there's a formula to solve for no plat in column G, which is basically your operating income times 1 minus the tax rate. So we're going to do the same thing in cell H11. So basically, we can either take the operating income times left paren equals operating income times left paren 1 minus the tax rate. Ooh, too many decimal places. Or option B, take cell G11, copy and paste it to H11. And then non-operating gains and losses equals the previous year. And that is something which we're going to make yellow. Okay? So those become basically the 5 income statement driver ratios that we are going to forecast. Again, questions about any of this? Hopefully pretty straightforward. All right. So next, we're going to copy this and we're going to paste this out to column M. Copy, paste, there we go. So that we have 6 years worth of forecast data. Okay. So essentially just that's arbitrary for how we're building the model, but basically we're building the model with 6 years worth of forecast data, 6 years of historical data, 6 years worth of forecast data. So those are 6 years worth of income statement ratios just repeated. All right, so our next step will basically be to go to the income statement and start creating the income statement based on those ratios. So for 2022, we'll start out with EBITDA. So for cell H8 equals, from the ratios tab, EBITDA as a percentage of revenue for 2022, which is H7, times income H3, which is 2022 revenue. That would be $35,963.1 million. Okay. Now we're going to do depreciation and amortization the same way. So for cell H9 equals, from the ratios, depreciation and amortization as a percentage of sales, which is H8, times income H3. All right. Operating income, we're going to solve for that. Again, you can see over here the pluses and minuses on the left-hand side of the screen. So EBITDA equals, EBITDA minus depreciation equals operating income. So H8 minus H9. 24062.2. Right. So very quickly, we've gotten to a forecast for Walmart's 2022 EBITDA and operating income. Right. Continuing on, next we have to forecast the rest of the income statement. So for interest expense, per the book, when we do an enterprise DCF, we assume a constant capital structure over the life of the company. So since it's going to have a constant capital structure, right now we're going to leave the debt and equity alone. And it's just an assumption we're going to make when we value the companies. And what you're going to quickly find is it has no impact whatsoever on the valuations of the companies. So we're really doing this more for window dressing. So interest expense equals the previous year because we're going to kind of leave the debt alone. Interest income equals the previous year, because again, we're going to not change that. FX gains and losses, 0. We don't know what's going to happen to currency in the future. Therefore, we're not going to forecast it. Okay. Income and loss from affiliates equals whatever it was the previous year. Non-operating gains or losses equals ratios H12 times income H3. So basically 2022 revenue times 2022 net operating gains and losses as a percentage of revenue. Okay, and that would get us to our pre-tax income. Just a simple way to get this really quickly. If you look over here for the formula for pre-tax income, that is cell G16. So what we're going to do is we're going to copy this and paste this over to G16 just to make it easier rather than typing and pasting or typing all the pluses and minuses. So just copy and paste that. Income tax expense equals pre-tax income, which is H16 times ratios, 2022 income tax rate, H10. Income before extraordinary items equals pre-tax income minus income tax, 14,709.5. Extraordinary loss net of tax, 0. By definition, extraordinary items are just that. They're extraordinary. They shouldn't recur into the future. So therefore, 0. Okay. Income before minority interest. It's basically the income before extraordinary items minus extraordinary items. If I'm lazy, I could take cell G20, copy it, paste it into H20. Minority dividends, minority interest payments. Again, because we're leaving the capital structure alone, whatever they are equals the previous year. Gives us net income equals net income before minority interest minus minority interest. Gives us net income to common shareholders of 14,513, net income. Then we're going to have our dividends. Whatever dividends they're paying, they keep paying, because again, we're leaving the cap structure alone, equals the previous year. Other adjustments to equity, kind of like extraordinary items, those are 0. Those generally occur when we have accounting changes. They generally are non-cash, and so therefore aren't really going to affect our valuation anyways, and we don't know what the accounting proclamations are going to be in the future, so therefore 0. Net income available to common shareholders, take cell G25, copy it, paste it to H25. Common dividends. Whatever dividends they're paying, again, since we're leaving the cap structure alone, we're going to keep paying, so equal the previous year. And so finally, we do change in retained earnings. The key to change in retained earnings is it's net income minus the dividends. That's how much retained earnings will grow or shrink by. But the problem is double negatives. If I subtract a negative, then it's the same thing as adding it. Okay? And I'm actually reducing it by the dividends. And this is just a formatting issue in Bloomberg. For whatever reason, Bloomberg chooses to, on the income statement, list cost as a positive number. But on the statement of cash flow, it lists dividends as a negative number. So you got to just be careful about the signs from the data services that you're actually getting your data from. So in this case, even though the formula is basically H25 minus H26, what we're going to actually do is H25 plus the negative number in H26 to get our change of retained earnings. Okay? That's just a little quirk of the model. But same thing with preferred dividends. So for preferred dividends, if they had them, they would be listed as a negative number. Okay? It's experience in Bloomberg. So what I actually did, which is why I told you to copy over G25 to H25, is you'll notice it's H22 plus H23, not minus H23 because of the potential double negative issue. So again, we've already solved for that in the model. So again, you should very quickly get income of 8397.5. Take column H, copy it, go over to column M, paste it, and 2027 net income should be 14,520.8. So very quickly, about 15 minutes, we have created a 6-year income statement forecast for Walmart assuming that the ratios of 2021 repeat themselves. And in your model, you should get 14,520.8. That's how you're going to be graded. So if you have that number, you're good. If you don't have that number, you just get a 0. That's okay. But good news is you have between now and Wednesday to make sure you get this number. Questions on the income statement?
I have a question.
Yep.
So you only use one decimal place after each of your numbers? Because I think I left it as 2, and that's why I'm getting a different answer.
Yeah. I mean, as long as you're getting it to the rounding error, you're okay. I just did it just for simplicity. It's because these numbers get kind of big. But yes, I'm doing it to one decimal place.
All right, gotcha. Thank you.
Sure. All right. Now for the fun part. On your midterm exam, you had to spend a lot of time doing a TII. So here's what we need to do for TII. So cell H1, write forecast. Equals previous year plus 1. Actually, don't have to do that. Just take G2, copy this, and go from H2 to M2, paste. There you go. So because the TII is all relative references, back to that standardized income statement, when we forecast our TII, it will basically correctly put everything in the right categories, and most importantly, it should balance. Okay? If at any point in time you have a non-balancing model, you have an invalid model. And in this class, you will not get credit for an imbalancing model. No matter how much work you put in, an imbalanced model is not a valid model. Okay? So we'd have to go back and we'd have to fix the model to figure out what is wrong. Now, generally that shouldn't occur, but if it does, we have to figure out why our model is broken. Okay? But very quickly, we have a TII that is balanced for Walmart. All right, questions about the income statement? So the number that you're looking for, again, for credit in the assignment, 22,149.8 is the 2027 TII. Because this is the column that's going to be checked on all the tabs.
I got 22,141.4 and I was following along.
Okay? Don't know what you did.
I got the same thing. I think the difference is like cells like 8 through 11. I think if you did 0 instead of like highlighting over and copying the cell, then you can get like slightly different numbers.
Which cells?
8 through 11, like the ones that have a dash next to them.
Okay.
Like I think when you did the income statement, you plugged in 0.
Yeah.
But I think some of us might have just copied over the previous year's cell.
Oh no, you don't want to do that. So when I put 0, you need to put 0, just so we have the same model. So back to income for, it's probably going to be these. FX gains or losses, 0. Income loss for affiliates equals G14. The other thing you got to be careful about, which could be happening to you guys, is the drag and drop Microsoft screw you over feature. You'll notice I'm copying and pasting. I'm not dragging and dropping because dragging and dropping can cause problems with your model. So
that's what happened.
I don't know why they
zeros counted upwards instead of staying 0.
Yes.
So
Every
anybody
now
with
and
that
then,
issue?
Microsoft, trying to be your friend, says, aha, you're dragging and dropping. You might be trying to create a series. So I'm going to create +1, +1, +1 in all those cells. And it didn't tell you it did it. And then suddenly your model's all off. You can't figure out why. That's why. So exactly, you had the drag and drop problem. And so you'll notice in this class, I don't drag and drop. All right, because 9 out of 10 times you can drag and drop, it's fine. But that 1 out of 10 times that you just had, it's pernicious. You're like, why is my model off a little bit? And it just go crazy. And then at the end of the day, it's just like, it's not worth it. So anyways, don't drag and drop, copy, paste. All right, let's get on to the balance sheet. So now we're going to go through the balance sheet ratios. these are the 11 balance sheet ratios. We're going to diverge from the book slightly here. All of these balance sheet ratios are a percentage of sales. Okay. Now, ideally, what McKinsey argues, and I think it's the right way to do it, is you want your balance sheet ratios based on the income statement driver. So, for example, accounts receivable should be based on sales, but cost of goods sold, or sorry, inventory should be based on cost of goods sold, as an example. But for our purpose, we're going to do everything as a percentage of sales. 2 reasons. One, it's easier, and it doesn't really make that much of a difference at the end of the day to do it the other way. And number 2, there'll be a reason that I'll explain to you next week, but it actually helps you when you forecast your model, okay, to do it this way. But regardless, this is the way that we're going to do it. So everything here is a percentage of sales. So we're going to start with accounts and notes receivable as a percentage of sales. So equals the previous year. So H14 equals G14. This is going to be a yellow cell. And now for the easy part. Take cell H14, copy it, and select all the way down to M24 and paste. Okay. And then last but not least, the formatting of this column or this row got screwed up. So this is not a percentage, it's decimal place. So just switch it back to decimal place. All right. So this is, and by the way, this is actually a report. So take this to be non-yellow. Okay. All right. So what we're saying here is this just represents the balance sheet ratios for 2022 to 2027 staying the same as they were in 2021, just as placeholders, so we all have the same numbers to get started, okay? And this final row is invested capital to sales, so it's just productivity based on the balance sheet, okay? Now, based on these ratios, we're going to go create a balance sheet. So over here, the balance sheet, just like we did the income statement, we're going to start forecasting 2022 and beyond. So I'm going to label cell H1 the forecast equals previous year plus 1. And then we're going to basically take these 11 balance sheet items. It's going to be a repetitive process. Do this 11 times from the ratios. And we're going to create the corresponding, starting with accounts and notes receivable, the corresponding balance sheet item for accounts and notes receivable, and then I'll work our way down. So for 2022, cell H6 equals, from the ratios tab, 2022 receivables, accounts and receivables as a percentage of sales, so H14, times, from the income tab, 2022 revenue forecast, which is H3. And again, select this, change my formatting to currency 1 decimal place. All right, so 6953.6. All right. Next, unbilled revenue equals ratios H15 times income H3, 0. Now, Walmart doesn't have unbilled revenue, but another company might. And since we're going to do this as a reusable model, we're still going to put the formula in. Inventory dollars for 2022 equals, from the ratios tab, inventory is a percentage of sales, which is H16, times income H3, 2022 revenue, 47,967.6. Other current assets equals ratios, other current assets is a percentage of sales, which is H17, times income 2022 revenue H3. Next, long-term investments and receivables equals, for the ratios tab, H18 times income H3. Net fixed assets equals ratios H19 times income H3. Next, we have other long-term assets as a percentage of sales equals ratios H20 times income H3. Next, we have accounts payable as a percentage of sales equals ratios H21 times income H3. Other short-term liabilities equals ratios H22 times income H3. And then we have long-term liabilities, which is right here, equals ratios H23 times income H3. And then our final one will be our, that was it, short-term, long-term liabilities. Okay. So those would be the key balance sheet ratios that we're going to forecast as a percentage of sales. Now, once we've done that, we need to finish up the balance sheet. And what's going to be very important when we finish up this balance sheet is that number one, it balance, and two, we don't have a circular reference. So two things will give you an invalid model. Number one, if you don't have a balancing statement, that's an invalid model. Two, a circular reference is not a valid model. So I'm going to show you how to create a forecasted balance sheet without a circular reference. And the way we're going to do that is we're going to finish off the liabilities and equity side of the balance sheet first. So let's start with the equity. Again, the working assumption is we're leaving the cap structure alone for the firm. Okay? So therefore, whatever equity they have, they leave alone. They don't issue or repurchase shares, common or preferred. So if they had preferred, equals the previous year. So cell H28 equals G28. Minority interest equals the previous year. H29 equals G29. Share capital and paid-in capital equals the previous year. So H30 equals G30. Retained earnings. Okay, this one will change. So it's going to be for cell H31 equals the previous year's retained earnings, which is G31, plus from the income tab, the 2022 change in retained earnings from the income statement, which is H27. Because that's how much retained earnings should go up based on the income statement. Okay? And if I sum those four items, that's my total equity, 95,928.5. Okay? Now, got to finish up liabilities. Go back to short-term borrowings. Again, we're not mucking with the capital structure. Therefore, whatever short-term debt they have, they keep. Equals last year. So H20 equals G20. Okay? Therefore, total current liabilities is the sum of the three items above, H19 through H21. That will be 98,511. Same thing with long-term debt. Whatever long-term borrowings they have that are interest-bearing, we leave alone. Equals previous year. So G23. H23 equals G23. And same thing with pension liabilities. Whatever pension liabilities they have, if any, we leave those alone. Equal H25 equals G25. Therefore, long-term liabilities are the sum of long-term borrowings, other long-term liabilities, and pension liabilities, the sum of those three, H23 to H25, which is 73,285, which means total liabilities is current liabilities, which is H22, plus long-term liabilities, which is H26, would give me my total liabilities, 171,796, and my total liabilities plus equity equals the 171,796, which is H27, plus total equity, which is H32. 267,724.4. Okay. So that's how much that half of the balance sheet would grow based on our forecast if 2022 repeated itself for Walmart. Now, this very next step is very important because we're going to make sure that the asset side of the balance sheet equals 267,724.4. So I'm going to show you how you do that. You go to cell 816, which is total assets, equals H33. Miraculously, your balance sheet balances. It'll balance every time. So you might say, well, gee, that was easy. But what that does is, okay, I forced the balance sheet to balance, but now we're going to need to make sure that everything above on the assets adds up to 267,724.4, which means we're going to use the concept of what's known as a plug, all right? Which means we're going to solve for a number that basically forces the balance sheets to balance, and the plug is going to be excess cash. That's the number that we're going to plug for. Okay? So we need to forecast a couple other numbers. The first one is operating cash, which is H4. Now you'll notice operating cash was not on the ratios tab. So operating cash is on the assumptions tab. And the reason why is because we're assuming that operating cash stays constant throughout our whole model. We're not changing it year by year, which is why it's on the assumptions tab. So for the balance sheet, for cell H4 equals assumptions B3, which is operating cash as a percentage of revenue, times income H3, which is 2022 revenue, enter, gives us operating cash of 11,934. Okay. Now, here's the other thing. I want to then edit that cell, and in front of the B, put a $sign, and in front of the 3, put a $sign. And the reason why is that in just a minute, when we copy and paste these cells from column H to column M, I want to make sure that it always refers to cell B3. Okay? Because when you copy and paste across rows and columns, Excel will change the relative reference, right? But since it's always going to be that cell, that 1 year, we're not changing operating cash. I don't want it to do that. So I'm making an absolute reference to that cell, which is the $sign B, $3 in Excel. That makes it an absolute reference as opposed to a relative reference. All right, so then the final number here is we have to do goodwill. The assumption on goodwill is two things. Number one, we don't know what acquisitions the company's going to make in the future and the prices that they're going to pay for them. Therefore, we can't forecast them. And number two, historically, goodwill is no longer amortized. It's impaired, which theoretically means it can stay on the balance sheet forever, right? So since it's a non-cash item when it's impaired anyways, won't really affect our valuation. So what we're going to do is we're just going to leave the goodwill alone, equals the previous year, right? Because again, it's not going to really have anything to do with the value of the firm at this point going forward. So equals previous year. Right? All right, now that we have all the key items forecasted on the balance sheet, we're going to solve for excess cash. So H5 is the plug. So equals for cell H5, H16 minus everything else, minus H4, which is operating cash, minus H6, which is accounts and notes receivable, minus H7, which is unbilled revenue, minus H8, which is inventory, minus H9, which is other current assets, minus H11, which is long-term investments, minus H12, which is net fixed assets, minus H13, which is goodwill, minus other long-term assets, which is H14. Enter 7545.8. And most importantly, you don't see a circular reference. Finishing out the window dressing, total current assets, which is cell H10, is everything above. So equals the sum from H4 to H9. Long-term assets equals the sum from long-term investments, so H11 to H14. And if I just wanted to do a check, equals current assets plus long-term assets. Notice they add up, which is important because I got to have my balance sheet balance. Delete that cell. So now take column H, copy it, select the column M, paste. I now have a forecasted balance sheet going through 2027. And again, the number that's going to be important for you, 368,971.1. Come over here to TFI. Column H is my forecast. Take cells G2 to G22, copy it, and paste it from H to M. A little wider. But I now should have balancing TFIs that go through 2027. Now that I finished the TII and the TFI, and again, 218,737 is the number that we're looking for, go to my CFI. I can now copy and paste forecast my CFI from 2021, so copy column G, go to column M, paste. I now have balancing CFIs that go through 2027. Economic profit, same thing. Put it in the forecast label. Spell correctly. G2 to G26, copy that. Column M, paste that. And so I have balancing economic profit based on beginning of year capital. And finally, EPEOY. Copy column G to column M. I have economic profit based on end of year capital. So, very important, 12102. 7629. Those are your important numbers that you have to match. Again, if you haven't matched that, you don't have a valid model. So this is where you have to get to. Questions? About anything?
What was the other number?
The 7629 or
The other one.
UI 12102.
Thank you.
Just trying to match this. All right, so just a quick refresh. What did we do? In a relatively short period of time, we took 6 years of historical data from Walmart that were put into a standardized format for the income statement and balance sheet, which created 6 years of historical ratios, all tied to the income statement. We forecasted these ratios for 6 years, which then created forecasted income statements and balance sheets. which then gave us economic statements that were forecasted of TFI, TFI, TII, and CFI, as well as EP, the two EPs, and everything balanced. So at this point, we're now ready to begin the actual valuation, okay? And we're going to translate this into an enterprise DCF. But that's where we're going to pick up on Wednesday's class. So at this point, we're going to stop, so everybody's going to be in the same place, and this is the file that is your next homework assignment. So this will be save, stop, share, Chrome. If we go to assignments, this is homework 8. No, homework 7. Okay, on Walmart. WMT. So that's, you're welcome to start submitting this assignment. So like I said, if you've gotten to this point, you can submit homework 7. If you didn't get to where we were in class, you have until basically 10 a.m. on Wednesday to get to that point. What we will then do is we'll pick up at that point on Wednesday, and then we will finish up the enterprise DCF part of the valuation of Walmart. Questions?
There'll be a recording posted, I'm assuming, correct?
Yes, this has been recorded. As soon as I hit, end class, it'll start processing, and I'll also post it on YouTube as soon as it's ready as well. All right.
I had a quick question.
Yes.
I wasn't sure if you still had the file open, but I was going to ask this earlier. For extraordinary loss net of tax, was that supposed to be 0, or were we copying that over from the year before for our 2022 forecast?
You're talking about on the income tab here?
Yeah.
Yeah, that was supposed to be 0. And the reason why is, as I said, by definition, extraordinary should be, by definition, extraordinary. It shouldn't happen in the future. So we don't repeat one-time items, because by definition, they're supposed to be one time. That's why it's 0. And generally, you don't know what a one-time extraordinary item is in the future, almost by definition. So therefore, forecast them. Now, and I will tell you, in reality, if you're doing this in the real world and you know somebody's going to do something that's a little bit off from what we've done here in class, you can always change the model. I'm trying to basically give you the 80-20 of what matters most for the reusable valuations that we're doing. But I mean, that's the difference between what we're doing in class and what the pros do, is the pros get a little bit more granular. But the flip side is this model works. Like, you're going to find out that very quickly we're going to actually have a fairly decent valuation of Walmart next week. And then it works pretty well for public companies as well when we reuse them. Okay. But regardless, that's what you do for extraordinary.
Okay. Thank you.
Mm-hmm. All right. Well, if no other questions, again, I will go ahead and see. Somebody was okay. I will stop the session. As I said, as soon as the video is posted on YouTube, I'll send a link in case anybody needs it for more time. But have this file ready to go, because this is exactly where we're going to pick up at the beginning of class on Wednesday as well. So submit it and then have this file ready to go on Wednesday. And just as a reminder, you all have to do this individually. You can't be sharing files here. Okay? That's the only way you're going to know how to do this, is if you do it yourself. All right, otherwise, it would be an honor code violation. All right, everybody have a good day. Safe week. See you on Wednesday.
Thanks, Professor.
Thank you.
Thank you.
And that other team, make sure you trade.